Alrighty, I think we're live here on LinkedIn and Facebook as well as YouTube. You're live with Real Fridays with Rick Rock and Brock Cassidy, and soon to join us, the pride of Detroit, the pride of the Rust Belt, the pride of the Upper Midwest. We have Jeremy Potter, who's going to be joining us hopefully here soon. Did he even did he confirm or what? I'm trying to figure out if
he's on Jeremy time of some sort. Yeah, I'm not sure. I think he's supposed to be here. I talked to him earlier today, but wouldn't say I got like a super clear confirmation.
Got it. Well, no, I'm looking forward to having him join. Of course, it's always good. We always survive without him, but it's always a better conversation with him for sure. But no, this for those who are just joining us for the first time. Nancy Coughlin, love her. She's actually going to be joining from Jacksonville, Florida. She's going to be joining NFM Lending, which we're super excited to have her on board. She and her husband are avid real estate investors and very smart. She's a very smart loan officer. So I'm really excited to have her, to be working with her and to grow her profession, her mortgage practice in her market. So
I'm going to Jacksonville, Florida next week to launch a new partner. So that's funny that she's coming out of there.
Is it an IMB or is it a credit union?
Depository bank, actually. Getting back into more mortgage focus.
Oh, that's interesting.
Yeah.
I'm wondering if, I guess given the rate environment, but rates haven't really improved all that much. In fact, they've gotten worse. I wonder what what that's going to say to depositories, because it seemed like for a while depositories were getting out of the business at a pretty alarming rate.
Yeah. We well, part of what we offer, and we don't have to make this too much of a news of commercial, but part of what we've been able to
it always is. I always make it a news of commercial.
Part of what we've been able to offer some of these folks, both in the credit union space, in like the regional bank space, is like if they got a little bit out of the mortgage focus and maybe don't have the real estate agent relationships that they would like or had in the past, or in this case, they want to expand geographically, where they were maybe good in New England, but they want to build a business in the Southeast or whatever in the mortgage. We can help them spin that up with our agent partnerships and our marketing and everything else we do, integrating with their existing tech stack. So that's kind of what we're doing here. We're going to Jacksonville, Florida, new direct consumer site for a bank that's growing in that region.
What percentage of your clients are depositories versus non-depositories?
If we count credit unions, it's probably about 30%. It's probably like 25% credit union. It's 25% credit unions, 5 or 10% regional banks.
Is there such a thing as a non-depository credit union?
Not really.
So depositories.
Yeah. So call it 50% total. It's just like the nonprofit model versus the profit model. Yeah.
So, but that term depository versus non-depository, it's almost like non-depositories include brokers as well, right? Brokers are financial institutions.
Yeah, they're the least depository.
Yeah, well, no, but independent mortgage banks are non-depositories, right?
Right.
And it is interesting because you get a lot of people looking at the mortgage pie from different angles, right? And it tends to confuse people when they read the data because they don't understand what the data is really referring to. So when you talk about lenders, right? Oftentimes, like the CFPP will talk about lenders as if they're talking about loan officers, right? As opposed to we talk about lenders in the context of independent mortgage banks, right? Yeah. When you say lenders lend their own money effectively, right? So when you read these market share studies or you read these studies around when they're parsing the industry in different segments, depending upon who the market researcher is, will depend on how accurate it really is, because oftentimes they'll completely misunderstand or completely misquote because they're numbers on the market because they don't really understand what they're looking at.
And all these groups that have some overlap, I'll use for example credit unions and regional banks. They like being separated. They consider themselves very different types of companies, very different types of people maybe, or very different business focus anyway. So it's kind of, so I think like that kind of like begets it getting more confusing where,
it's really important. It's funny, before Ingenious came around, you'll get a kick out of this. I used to do, lenders used to pay me, not just me, but this organization called Wholesale Access Research. And I used to work with, I'll have to, he's really an amazing. He was kind of a legendary figure in the late 90s. I want to say his name was Olson, David Olson. God rest him. He's such a good guy from Massachusetts. He lives in Massachusetts, and I worked with his daughter. But back in like 08, 09, 2010, 2011, there was no central resource to determine market share for tech, market share for origination platforms, market share for lenders. And everyone wanted to know, what is the broker market share? What's the IMB market share? What's the credit union, commercial bank, community bank, that sort of thing. And so what David and I and his daughter would do, Christine, we would actually assess that statistically. We'd go at it and we would do a statistical representative sample in various geographies around the country. And we'd publish this report and we'd interview these lenders. And lenders who wanted that study, it was probably a 100-page research document. And lenders or people who wanted that study would pay $30,000 to $40,000 just for that study, right? So we would get 100 institutions out there to pay us that kind of money in order to get to be able to see. And it's amazing how that's a good trajectory on technology, right? Here's this ivory tower kind of effort. You have to pay a lot of money. Not a lot of people have it. The access is really low, and the effort to produce this kind of content is really high. And then now I could subscribe to Redder or Ingenious or MMI for $100 a month and get access to way more data than we were collecting. And it's immediate.
Yeah, I'm an Ingenious data fan for many reasons, including that I've known those guys for a long time and helped them a little bit early on. But literally yesterday, I found out about a new report I'd never used over there to tie together a bunch of real estate data with a bunch of mortgage data that now I'm going to use with a bunch of my partners. So it's pretty crazy the trajectory there. I think we had Jeff Walton on here, the CEO of Ingenious, 2 weeks ago or 3 weeks ago. And some of those things he was talking about of querying all that data using an AI prompter or whatever, the next phases of this, I think, are going to make it even several levels higher of improvement, ease of access.
Excuse me. I just think that's just such a fascinating, such a fascinating illustration of A, you can't get too comfortable. B, technology is very fast. And C, the evolution, the behavioral evolution is to democratize information. And people say this, right? People say, oh, it's about the democratization of information. But the reality is it is, and mortgage lenders, as we invert this paradigm, right, where one day real estate agency or mortgage lenders end up capturing title and appraisal and home inspection up front, right? And that data is maybe democratized. It's probably going to be free one day to be able to order an appraisal automatically in AVM that's reliable, order home inspection. It gets done. It's all bundled in the transaction, and all that stuff gets done up front. The more the consumer or the more the buyer or the consumer of that information is in control of it, the more of an advantage the technology is going to be, or the model. In our model, we were the Dr. Rick Rock, Dr. Olson, we were the arbiters of this information, controlling it. We would charge big ticket dollar items for it. And the reality is that was maybe that was an era that was long bygone, right? And now it's an era that puts digitally that information in the hands of fingertips of consumers and professionals alike, at a much more accurate, delivered at a much more affordable cost. Isn't that interesting? And that happened in what, a decade? That happened in probably 6 years, 5 years.
Yeah. I mean, for my purposes, I've seen so much change in the 3-4 years that I've been, around that data. And when I was working at Rocket for the first 7 years of my career in the industry, it was they had acquired every expensive data set in the world and merged it together because of who they were. But like now, doing it on my own has been a project the last 4 years, let's say. And that's been a lot more interesting, and it's happened a lot more quickly. But I will say there probably is some of these self-serve tools. People still do want someone to interpret it for them. So there probably is still a place. I subscribe to a bunch of mortgage newsletters. You probably do too. Go to these conferences. People still want to, and maybe that's a purpose of this podcast in a certain way, is that people do want that data interpreted for them still. People do still want someone they trust to make sure that they vetted the data, make sure that they maybe looked at it in 2 or 3 different tools, like things like that, because some of it's almost too available, like you heard it on social media or something. It's like, is that real? I don't know.
Well, fair, right? Accessibility to data and information does not guarantee, or access to it does not guarantee accuracy. But at the same time, I think the more access to data and information, it's almost like Wikipedia. Yeah. I think the theoretical idea is that the higher the bar is, and the higher the dependence is onto the accuracy, and so there's more pressure for it to be accurate. And so over time, the hope is that it sort of churns itself into a more accurate end product. Yeah,
no doubt, and it's definitely continuing to head that way. And I love the new layers being put on top of it to prevent some potential errors, like what Jeff was talking about a few weeks ago, with making it easier to prompt, making it integrate with existing systems, so that the data just comes in naturally instead of having to be dug into and queried always. But yeah, what else is new in your world the last couple of weeks? We're in the middle of the conference circuit. You're what, a month in, 2 months in to NFM now?
Yeah. No, things are going really well. We got back just about a week ago from the Housing Wire conference and the IMB conference, I think, which was a really fantastic conference. I posted pretty heavily about, I think, how Housing Wire has really, raised the bar for the content of these conferences. And I think as they continue to, put on these conferences, the pressure is going to be to continue to deliver on really valuable content. I think I'm a big fan of the MBA. I do think that the MBA conferences tend to be fairly, or have historically been, a little bit sterile, a little bit more political, policy oriented, which is fine. And it's good from a content consumption standpoint, but it's not as conducive around the tactical, like, how do I manage my business today?
No doubt.
Like what strategic moves on the chessboard. I don't care about the theory of chess. I don't care about what new, rule changes or could be to the game. You know what I mean? I just want to know, I have my pawn, my rook, and my horse, and this is the positions on the chessboard. Where do I move them?
Yeah.
And sometimes you can't really understand that until you get other people who understand exactly, how they're cornered in the same ways by the same pieces. And all of a sudden you're saying to myself, shoot, I was there, do this, don't do that, because you'll get your piece taken.
Yeah. So I'm on a committee with the MBA. So they are making steps to make it more relevant for more people newer to the industry that aren't as policy focused. I think is one thing that they're explicitly focused on. So hopefully we see some progress there. And
good for you for doing that. What committee are you on?
The impact. It's like people like newer to the industry, next generation of the industry type thing.
Yeah.
So it's been cool, and trying to live up to that expectation of bringing someone on my team who's extremely new to the industry, a couple of years in the industry, less than a year at NewZip. And it's really going to be her first. She's been to a couple of regional credit union conferences, but it's going to be her first mortgage conference. So I was just thinking, like, gotta talk my own book here and start bringing new people to these events and see how they go, and start exposing more people to these types of events, and keep pushing the MBA to make it more relevant for more people, not just kind of the industry policy folks that it is a huge role for them, obviously, but maybe not the most relevant to most of their attendees. But the thing I love about the MBA conference is that it's such a jumping off point for everyone else.
Yeah.
We're going to have a client dinner I've gotten, I don't know how many invites to different receptions, happy hours, get coffee with people, get dinner with people. You know, there's probably 30 plus spinoff receptions that I know of, probably 100 that you know of. So it's a nice like platform. It's almost like some of these huge tech conferences where they like take over a whole city for a few days, right? The MBA is like kind of the closest thing we have to that.
Yeah, no, I agree with that. Look, I don't think that there's any association that does more from an advocacy standpoint, probably between the NBA and the Community Homelanders Association. The Community Housing is a CHLA, isn't that?
CHLA, yeah.
Just from a pure advocacy standpoint, to lobby for both. It's kind of hard to say lobbying just for originators of mortgages, but because obviously you can't do that effectively without having the consumer squarely at the nucleus of those policies. So I kind of look at them as both the consumer advocacy, kind of the seesaw between doing what's best for the consumer and doing what's best, because, you know, by way of protecting the industry, and doing what's best for mortgage lenders to drive costs down, and of course to increase margins, you know, from a cost standpoint. So
yeah, it's like a multi-sided thing. Help get lobby to help Washington, help us, help the consumer.
Yeah.
Something like
I didn't know you were on that. Jeremy, you ever been on any MBA committees? You know, early in my career, I was from like the residential tech committee, and there was a couple different committees I was on when I was probably Brock's age, probably in my 30s, early 30s. But have you ever done any from a legal or regulatory standpoint?
Yeah, I did I chaired the state and local regulatory committee for a minute on ResBog. And then I did a bunch of affordable housing work with a task force of ResBog called the Affordable Housing Advisory Council, which I'm currently doing right now.
Nice.
That's fantastic, man. So, like, what is new in your world, Jeremy? I know that Brock and I caught up a little bit. I was just talking about our time together at the Housing Wire conference in Dallas, and I did get your feedback on the video clip that we still need to sort of publish on LinkedIn. I thought it was a good interview, and the three of us should organize that and publish that. You know, I haven't yet. I don't know if you guys have.
No disagreement. I just I watched it. I said to myself, I'm going to post this later, and then I ended up saying that 3 or 4 times over the last 2 days, and just got caught up in other stuff. So I'm glad we got a chance to catch up and record that. I think you did a good job getting your day captured so that you could share it. The only thing people are going to see in that clip, I think, goes to just there's a disconnect between the optimism around lower rates and the market,
Yeah.
and what's realistic expectations.
Well,
and that maybe is always the case, but I think it's going to be very stark over the next 2 quarters that we're optimistic. We're starting to talk about housing. We've got slightly lower rates, but I don't know that it's going to translate into financial stability for a lot of companies because of how competitive it just got. But other than that, we'll share it around, and there's good vibes.
Well, we're in this inverse curve right now, right? And this has been what's perplexed a lot of mortgage professionals, or really consumers, is that how could the Federal Reserve cut interest rates 50 basis points and yet mortgage rates go up? That's been sort of both the headline and the opportunity for us as professionals to understand that there's often an inverse relationship between the bond market and what the Treasury does. And so it's kind of like the Treasury did a reduction, and then the bond market had an inverse reaction to it, to indicate that really the economy, and I hate to say this for my Republican friends out there, but that the economy is a lot stronger than it wants to give it, that they want to give it credit for. And as a result, the strength of the economy is what is resisting a reduction in the actual end rate on the bond market side.
Well, I think this idea to your point, I think there is a more of a realization of how this stuff gets priced in now, how the expectations get priced in ahead of cuts, how they were already baked in 2 weeks before. I think that stuff is starting to become more well-known. But I listened to a podcast yesterday that I really appreciated, which was Clayton's interview with Greg Schwartz from Tomo on the Housing Wire feed. And he was saying that they had, so regardless of what actually happens with rates, consumers tend to see the mainstream media, and when there's a rate cut, they go searching, Google SEO, or perhaps directly to a calculator, or directly to thing. So he was saying, like, not just did they have the most hits they ever had on the day that the rate cut was announced, but they also have sustained increased searches in like the lag after that over the past week or two. So it's almost like one of those things where perception becomes reality. In terms of interest, even if you as an LO or you as a mortgage company have to kind of like reframe the price once you get them in the funnel, nobody from the industry side seems to care because at least they've got an expanded funnel. So it's like
it accomplished one goal. It got more consumers to come back and talk to mortgage companies, but the rates aren't any better. Yeah, it's an interesting thing. I saw that applications actually went down 9% week over week, mostly refi. Purchases about the same, yeah.
Well, yeah, and mortgage rates have gotten obviously worse, so so that's kind of that's created sort of an inherent headwind. I've often said that sort of what's negative for the economy tends to be good for mortgage rates. So when there's a war in the Middle East or there's some oil choke point or something that kind of rattles the international market, international investors sort of go all in on mortgage-backed securities, which has a tendency of driving mortgage rates down quite considerably in a way that makes the cost, the borrowing costs or the lending, not the lending cost, but the borrowing costs on the consumer side more affordable. But then it has other economic effects around that because as the economy, as housing and employment numbers worsen, mortgage rates tend to invert to that and get quote unquote better, or get reduced. So it is a bit of a. It'll be interesting to see. What Bob Brokersmith had a session of this at the Housing Wire conference of what it is that you really want in depending upon your candidate. I think the net impact is going to be probably largely the same, potentially even better under President Harris, under a President Harris. Than it would be under a quote unquote President Trump, but we'll see. It'll be interesting to really see from a policy. I think it'll be probably from a mortgage volume standpoint, probably better under a President Harris. This is sort of my prediction. And it probably under a President Trump, the production volume forecast won't be as strong, but it'll be less costly. So the regulations. So I think we'll get more production under President Harris, but more regulation and therefore more costs associated to enforcement actions and so on and so forth. But our production outlook probably will be better. But it'll be curious to see how that might pan out.
Yeah, look, I don't know much as far as like political forecasting goes. Just as a guy in Detroit, what I will say is I don't know how you can predict anything when one of the two candidates is completely unpredictable. So like we have no idea what a President Trump would choose to do, because you can't rely on any of his policy statements because there aren't really any depth to them.
Yeah, that's right.
There's hardly an economic plan other than we're going to be great again. So that's not necessarily a criticism. It's working. Politically, it works. So like he's having success, electoral success, like it politically works, but there's nothing there to hang your hat on to say, this is what I can count on for my business, or this is what I can count on as a homeowner. Or like I said, a guy in Detroit, because it just doesn't seem like there's much there other than we're going to make it great. And we may fight China. We may deport some people. What are the economic results of that? I don't know. I mean, what's that look like?
It is kind of ironic because the Trump campaign will levy that they're not getting enough specifics and enough hard-hitting interviews and questions on the Vice President Harris. And yet you have Trump, who makes himself very narcissistically sort of available to the press and still doesn't say anything. So it's like different behaviors, but it's the same net result. You really don't get a lot of specifics from either camp. And to your point, I think it kind of works to stay on the platitude level than it is to actually get into any kind of policy depth.
It's just a high degree of trust, right? Like you kind of read these, like there's like a lot from the Harris side on the demand side, like demand meaning down payment assistance and other programs that like generate first-time home buyer demand. So there's a lot on the demand side, and you can hear people in our industry be like, well, that's probably too much demand because it'll push home prices up. So like nitpicking that policy, but then, you know, with Trump, it's sort of just like home ownership is the key. Well, great. We agree. I mean, our industry agrees, but like, what does that mean? What are you going to do? Like, are we going to do supply side innovation? Are we just giving more tax credits to home builders who don't build anyhow? Like, so what are we, we're just going to give a whole bunch of money to people who aren't building enough as it is? Like, there's no demand problem for new homes.
And there's some kind of like weird implication that like just gonna like make the Fed probably print more, but like that's a pretty non-political. It's at least ostensibly a non-political decision. So yeah, it's kind of a whole strange thing.
Yeah, so I guess just as the forecasting goes, like I'm more of like I have to take it day by day afterwards, like after January 20th to see, all right, here's what it is today, depending. So we'll see. Yeah, I don't know for our industry. Did Rick freeze?
He looks a little bit.
We rendered him speechless.
Oh, yeah. I think I had some latency. I had some latency on my side. Sorry about that. Yeah, it'll be fascinating. We're under 30 days. I mean, we're 3 weeks away from an election. I got my ballot. I got my ballot right here. So I got my ballot to cast.
How many ballots did you get for yourself?
It's how many ballots? Yeah, I'm going to vote in Vermont, Massachusetts. No, this is my North Carolina. So I'm a North Carolina resident. But yeah, this is the ballot I'm going to mail in. This is a real live ballot for the election. And I'm looking forward to casting it. And I encourage everybody, regardless of their party affiliation, to
vote. You got to vote.
You got to vote. Yeah, you got to vote. Even if it doesn't count, you got to vote.
Steer the New York vote with money.
Yeah, and if you're in Cook County, vote 3 times. But no, I'm excited to get on the other side of this political season. To be honest with you, I'm kind of over and done it. We're just starting to get inundated with, especially in North Carolina, with political ads, and it's like one after another, and it's just like I'm just kind of done it. I'm so glad I don't live in Iowa or one of the other battleground states.
Michigan.
Yeah,
I mean, one of my friends is he works at Fox Television, like the channel, not the news corporation, and he lines up advertising. His team is in charge of like the advertising management system, data and other things. And he always gives me the heads up when a big buy comes in for Michigan. He always texts me. He's like, get ready. More political ads coming your way this week. And I'm like, more? We are at 85% political ads and 15% pharmaceutical commercials. I don't know how we could go anymore. The only thing to get pushed out is pharmaceutical commercials will be at 100% political ads in Michigan. I don't know how there could be any more political advertising in Michigan. It's bonkers.
I know we're not even seeing the Rocket Mortgage and Zillow commercials anymore.
Exactly.
Now, are there any projects you can talk about, Jeremy, about what you're up to and what you're doing? Like what's and whether or not the market environment right now, because the talk of low rates and high production volume hasn't materialized. For most mortgage companies, I would say those of us on the enterprise side have experienced kind of a pretty strong uptick, but that's just because our footprint is so wide. When you're drawing from 49 different states or 50 states, one market could shut down, another market kind of opens up. If you're a small to mid-sized mortgage company, which tends to be most mortgage companies, and they're focused on one small geography and they don't really feel that sort of shift at the local level, those are the ones that tend to be really pinned down by these market dynamics. So how does that impact you? And are you feeling those shifts in your work with tech companies and mortgage companies?
Yeah, I mean, I think there's a couple ways it comes across. And one is the product development stuff that I do, which is how do I get into Fannie and Freddie? How do I get into a big lender? How do I go to market with my new idea? That tends to get exciting in these moments because lenders have a view that they need something or they want something. I think one of the things I've struggled with a lot, and I've complained about it on here a lot, is I have a lot of clients who are working on really cool tech or really cool solutions, and lenders just play games with them. When it's going really well and rates drop, it's like, I'm too busy to focus on that. So hit me up when I have a chance to look at it. And there's never a chance to look at it because they're either too skittish or it's not a good time with budgets because we don't know how bad business is going to get. And so what ends up happening in this industry is you end up buying solutions sporadically from people you know, your friends, not necessarily the best solution or the most beneficial solution. It's just timing, who's in front of you at the moment that you have a need, and that's who gets the deal. And there's very little vetting, comparison, or scorecarding.
So are you talking about like software products or mortgage products?
I like talking about mortgage products, although those are fewer and farther between. I'm really talking about production, operations, underwriting, point of sale.
So you're talking about technologies.
Closing and delivery. With mortgage products, it is what it is. Everybody knows nobody's doing anything new. So it is what it is. You know where to go for your DSCR loans. You know where to go for your renovation construction. You know where to go for your HELOCs. You know, and everything else is just Fannie Freddie. So, I mean, I've been very few non-QM lenders are trying anything new. I would say a small handful I can talk to are like taking a look at shared appreciation, community land trust type stuff a little bit, but that's 2 or 3 lenders across like the whole spectrum. Mortgage products are what they are.
Yeah. No, I mean, it's when everyone is so is feeding on the same trough, the same Fannie Freddie trough.
Yeah.
I actually put out there that there probably should be a GSE to buy non-QM products to be able to open up the non-QM sector, because I think non-QM is just always going to be relegated to that 2 to 3% space. I don't see a lot of upward mobility with any new innovative products unless there's some, like it or not, without some investment, public investment by the federal government and by the U.S. taxpayer in those particular products to open up those channels, because I just don't see it. There needs to be another liquidity facility, I think. And that would be the one thing. I'm not so much about not so much about privatizing, because I think what we have probably works, quite frankly, with Fannie, Freddie, and Ginnie. But I just feel like that there needs to be another public and private partnership, kind of a shared investment between private investors and public allocations to be able to free up and open up these new just new product innovation, because otherwise it's so bland, it's so vanilla.
Yeah, I mean, I think what I would say to that is there's no incentive for a private entity to come in and do that, because they can charge more because it doesn't exist. So, like, what's the upside to be the non-QM TSE?
Yeah, you make your investing, you make your IRR worse, right? Yeah.
Yeah, they can scale. They can get anything they want just by pricing to it, and they can.
But we wouldn't do a fraction. I mean, if FHA wasn't backed by HUD and wasn't it wasn't really a government backed, product, I mean, we wouldn't do any volume. They might charge an extra point or two. If it was an entirely private, it'd be a private money situation. Quite frankly, Isn't
that what you're talking about? That's what I thought you meant.
No, but I'm saying if the government, in essence, provides the government insurance on those funded loans to lenders would be much more active in closing loans, in closing those loans, and I think the affordability of those loans would go down.
I see what you're saying.
Yeah, you might make less money on them, but I think you're going to make a lot more just through scale. Because non-QM, I used to say non-QM was the next FHA, but it just always got backlogged. It always just got it's just the appetite, the investor, there's only a handful of investors.
I mean, I'm happy to go back and talk about the original idea behind QM. That's the CFPB. CFPB leadership believed fundamentally that there would be a robust QM and a robust non-QM that were equal in size, depth, liquidity, and activity. And that is not what happened. So they were attempting to create an active, robust private market alongside QM and fully invested, fully believed that that would happen. And these companies, these private companies, just rushed to the QM safe harbor and never did anything outside of it for 10 years and then trickled outside of it to today. So that was a miscalculation, I suppose, on the CFPB's part. But man, that was not the intent. The intent was a fully functioning, deep, liquid, non-QM market right next to the QM market, and they would operate in tandem. And private industry, private capital, and companies said no chance.
That's interesting. I wonder what it was about the legislation or the structure that they thought would drive that that demand or that product flow. Because it's like products are either a push or a pull, right? Either the market pushes it to being, or the government pulls it into being as a result of regulatory enforcement or government priority or whatever the case may be. That so I mean, I wonder what it was that they thought would
honestly, maybe it was the rates. Maybe they had forecasted a rate environment that looked more like this rather than one that was in the threes, and they didn't anticipate there would be so many homeowners refining 4 and 5 times over 5 years that mortgage companies in the private market didn't have to care. Investors didn't have to care about anything else because the CFPB didn't anticipate that guy in Orange County would get 6 refis with the same lender in a 5-year period.
Yeah, there was an unlimited number of nearly unlimited number of mortgages that were just there with the Fannie money, Freddie money. Yeah,
that's interesting. Yeah, that's interesting. I've always said that the normative rate environment really should be right kind of where we are in that 7 to 8% range. Just for a healthy market to be able to provide some kind of a jump. Because if you're selling 3%, 4% fixed rate mortgages, why would you want a 7 or 8% non-QM? But if there was somewhat planarized, and there was somewhat of a level playing field, I think it would maybe provide a bit more of a market appetite for those products.
Right on.
But yeah, no, look, it's looking forward. Obviously the NBA conference is coming up in 2 weeks. And then after that, I'm speaking at the IMB conference for the New England NBA. And I'm actually doing a panel, and I was going to see if you guys could actually do it with me. It's going to be at Mohegan Sun. I think at the 18, 19, 20 or 17, 18, 19 of January. Yeah. I was going to email that to you, but it's entitled Real Talk. I think it's actually called Real Talk. Because I had I had kind of a, it's kind of an assumptive close. I was kind of expecting you guys and hoping you guys would just accept and come. Because I know that you guys
getting to Mohegan Sun's pretty easy for me, and that's a good topic. Real talk at an IMB conference. That's perfect. So
yeah, it's the New England IMB conference, and so
you're talking about the Mortgage Expo. Just to be clear, yes,
yeah,
the Mortgage Expo.
I was going to say, that sounds familiar, but by another name. Yeah, and then NBA IMB National should be around that time too, late January, early February.
All right.
That's right. Yeah.
Right, I gotta go. I'm sorry to cut you off. I gotta run, guys.
Yep. No problem at all.
Station as always.
Talk to you later.
Take care.
Talk to you soon.
So we'll have to discuss that, and I look forward to the possibly working with you guys on that.
Cool. That'd be great.
It's kind of funny because it's called the Mortgage Banker Program at Mohegan. So it might be the New England Mortgage Expo. Okay, so they must have an IMB day or an IMB track or something?
Yeah, that sounds right. Yeah, I was most likely going to go to that anyway, so that's perfect.
Yeah, the title of this Real Talk. In the Trenches, mortgage leaders talk about the market experiences and forecasts. So what I was going to do is maybe have you and Jeremy and maybe one or two like originators, people who are, to kind of balance out the lending side.
Yeah.
So thank you, Nancy. Nancy's always on it.
Found it.
Well, good. Well, good to see you, Brock. As always, I love hearing your progress. You'll have to hook up. You'll have to connect with Nancy when you get to Jacksonville, Florida.
Maybe, yeah.
But I'm glad Jeremy was able to pop on, and I'm happy that we were able to connect today.
Yeah. Yep. Well, we'll see you out there in a couple of weeks. Look out for the invite to our New Zip partners and friends dinner the last day at the NBA. So,
love it.
Cool.
Love it.
All right.
We'll talk to you soon. Another episode.